Justin Goodin, welcome to the best ever CRE studio. Glad to have you on the show today, bud.
Yeah, thanks for having me, Matt.
So I was reading through your resume. You and I are chatting offline and everything like that. You have an interesting backstory because you've touched a few different facets of this business and then did what seems to me to be some logical pivots. Kind of soaked this up, and now I'm going to go and get into the new thing and whatnot, right?
Mhm.
So tell us about your first leg in the commercial real estate industry.
It's like my first commercial multifamily deal, I guess we can talk about, is a
Well, I'm talking
33
about
unit on west
banking.
of
I
Indianapolis.
want to go into I want to go when you got out of
Okay,
Indiana University. You
into
went,
commercial real estate. Okay.
yeah, because here's the thing, and the reason why I'm bringing this up, best ever listener, you don't have to like if you got a job you hate, okay. This is like I'm tangenting a little bit, but Justin, you hop in and agree with me, or tell me I'm totally off base, whatever you want, right? If a best ever listeners listen to this and they got a job they hate, right? Here's the thing. You don't necessarily have to drink the Kiyosaki Kool-Aid, Rich Dad Poor Dad, and go quit your job and start your own business and all the things, right? You could just go get another job in an industry that you like or that you're curious about. So Justin, coming out of college, you got yourself into an industry that is tangential to the real estate space. And I believe you learned a lot about what, you and I do now as active real estate investors. Tell us about that journey. Because I want you to inspire the best ever listener about the idea of perhaps a rung on the ladder for their career development could be, get a job in real estate for not forever. Nothing's forever, is it? Get a little, certainly for Justin, nothing's forever, right? So tell us a bit about your backstory and what you got out of it and why a best ever listener might want to consider that trajectory.
Yeah, so coming out of business school, I
Mhm.
was already sort of like in this self-education mode of like, consuming everything I could about commercial real estate and
Yeah.
about multifamily investing. So I was already like going down that path and knew I wanted to eventually start my own company, start buying multifamily assets, and start building my own portfolio. So what made most sense to me was getting a job, in the commercial real estate field, whether that
Mm.
be for a developer, a syndicator, uh, or a bank, which is where I turned out to apply and get a job at. So I was an underwriter for a bank,
Mm.
underwriting commercial real estate multifamily loans for either development or value add, light tech, and even like a little bit of healthcare properties in there as well. But my job was to analyze the risk for the bank and to make a decision on whether we should lend money to this borrower and this project or not, based on the analysis that I performed on the deal.
Mm.
And then I would then present that deal to the loan committee and then leave it up to them to actually get it fully approved or not fully approved. But that, like to your point, that gave me like a really good, like inside look into multifamily investing, into value add, into development. And the biggest thing, like as an underwriter, is that you see like everything when you're doing these loans. So
Yeah,
you
man.
see like the borrower's tax returns, you see their balance sheets, and I knew like I wasn't going to be able to get like that sort of net worth and that generational wealth by being on this side of the equation.
Oh yeah.
So I knew I wanted to eventually leave that job and pursue multifamily investing full time, which is what I
Oh
did
sure.
eventually.
Yeah, I know, right? You're not going to get a net worth of that you need to qualify for a commercial loan. With the W-2, it's a rigged system. I get it. But before we jump into listen, we're preaching to the choir, right? I mean, we're all entrepreneurs. We all get it. We all drank the Kool-Aid, and I do joke about Rich Dad Poor Dad, but we all did read Rich Dad Poor Dad, and we all know about that entrepreneurship is kind of the secret hack. It's not a secret anymore, right? Now, rewinding back to the banking thing. I've always been curious about this because those that are in the commercial real estate space that got into this thing day one had to either, watch some YouTube videos on how to underwrite or go out and buy some of the underwriting programs that are out there. How does a bank teach their teams how to underwrite deals? There's probably not underwriting 101 that you took in college, right? So when you worked for the bank that you did,
No.
they must have taught you how to analyze deals. How do they do that?
They basically just like throw you into the fire
Go get it.
and have you start like looking at deals and underwriting deals and working closely with somebody more experienced there.
Mm.
While I will say like there is like similarities between what we're doing as investors and looking at deals, there are also like a lot of differences between like how a bank will look at a deal.
Do tell. Get into that.
So
Because now now you drink Kool-Aid. You're on the dark side now. I got it. But
yeah,
you give us some insights as operators on how a bank is gonna underwrite a deal differently than the way that we do?
So for me, at least, like I was an underwriter for a bridge lender.
Mhm.
And as you know, and as probably like a lot of your listeners know, that a bridge lender is basically just a short-term hard money
Yeah.
loan for a commercial real estate property. So I was underwriting these deals that were going like either bridge to HUD or a bridge to like a Fannie and Freddie. So the bank that I worked at was not a long-term lender. Like these were bridge loans. They wanted paid back in 3 to 5 years. So if I had to sum up like how this bank was different, how they like looking at deals, their sole just priority was getting confidence on can this borrower take out the bridge loan, or i.e., buy it, accomplish their business plan, and then refinance
Yeah.
out of that bridge loan into a long-term debt product. And so we looked at different comps to see if they could achieve their rents. We're looking at the appraisal and what the appraiser concluded as far as market rents, job growth, operating expenses. We're doing all that, and like we're building a stabilized pro forma, back it into a DSCR,
Mm.
and taking all these things in combination with how experienced the borrower is, how realistic all are their assumptions and timeline, and just making that decision. Are we confident they can refinance out in 3 to 5 years and pay us back? Like that was what the
That's
lender was
it.
absolutely just most
Probability of
concerned about.
exit. They could care less about,
Correct.
"Oh, let's see how much cash flow he's making. What's the ROI to his investors?" and that kind of thing. Did the bank care where the equity was coming from as much? I feel
No,
like they
not that I
do.
remember. No,
Not really. Okay. I feel like they
no.
do, but I don't, maybe I'm wrong about that. When I apply to a bank, I'll say, yeah, I'm going to syndicate it, or no, it's not my money, or whatever it is. And that's you. So truth for the best ever listeners, banks actually don't care where the equity is coming from. As long as you got a day of closing and you can, show a reasonable path to the equity. That's not a big part. It's interesting because on our side, that's like one of the biggest underwriting points is this going to be attractive enough for my equity? Are they going to want to do this deal? It's less the other side of it of what's the probability of my exit. It seems like that's the bank's primary focus point is, are
Correct.
they going to be
At
able
least
to,
like from my experience and my perspective.
yeah,
Correct.
are they going to be able to take this hand grenade I just handed them and give it to somebody else before it goes off, right? Yeah.
Right.
Okay. What is it? Just unpacking a little bit more the banking side, either experiences that you had while you were on that, or just experiences you've seen in your own journey, people that you've run into in the industry. What's the biggest mistake that a best ever listener should know about, or a misunderstanding, something like a nugget that you got aha moment, either a mistake or a misunderstanding that borrowers tend to have when they're applying for these short-term bridge loans that came up for you in that experience?
I would say that they're kind of just, not all borrowers that I saw, not all business plans that I saw were realistic. So either like short timelines or very optimistic rent
We're going
assumptions.
to double the rent.
We
That's
had
it. Yeah.
double the rent in 6 months, and how fast that could be actually achieved.
Right.
So just I would say just doing more to like under promise and over deliver versus instead of like vice versa. But there was a lot of loans that didn't perform like up to like I guess like how everybody was thinking, just because like the timelines and the projections were just a little bit like overly optimistic, if that makes
Yeah.
sense. And this was back in 2019 and 2020,
Oh, yeah.
when debt was basically like 2-3%. These are all floating rate loans. These were all loans that had no rate caps back in the day.
Yeah.
So yeah, who knows what has happened in those kind of deals? I think we do know, but
Yeah, you do.
this was
know,
like
yeah, you
4 or 5 years
do. You
ago.
know
So
exactly what happened to those deals. Yeah,
yeah,
yeah. Yeah. Now, given the change that's happened in the industry and the market, what looking back on it now, and I know you're not in that world anymore, right? Because and now and we're going to move on to new worlds that you're in. But looking at the end at the changes that have happened in the industry, certainly no rate caps, that kind of thing. Are there any flaws that you saw aside from not putting rate caps or whatever, flaws that you saw in the system or changes that you think that those banks should have done? Anything looking back from today, 2026, looking at what happened from all this inflation and all that jazz to your experience in the banking industry, anything that you like from way hindsight now, you see as flaws in the banking side, either things the banks aren't doing anymore, or again, other lessons for best ever listeners that they could take to applying for loans today, because certainly loans are not 2 to 3% anymore.
I guess like flaws that I saw like in the actual banking world and just, my insight as a underwriter, what I saw. But, all banks have certain net worth and liquidity requirements in order to actually be a borrower and get approved for these loans. That's fine. But sometimes like these borrowers have 30, 40 other deals on
Mm,
their REO schedule. So while they're meeting the net worth and liquidity for this deal we're doing now,
right.
I mean, what happens if, 10, 20 other deals in their portfolio go bad? Like
Yeah.
how strong is that borrower
I
then? But
wondered that
that's
too,
sort of like
man.
a
Yeah.
that's like a big gray area, like in the banking world. So I saw like a lot of that and always kind of put a question mark on that as well.
It's funny, Justin. It's a silly little game that
Yeah,
these banks play, right? At the end of the day,
correct.
let's face something. The loan committee, the loan officer, they all have their own quotas too. Their job is not to turn deals down, right? Their job is to make
Correct.
the deals happen. Your job as the underwriter was to, certainly to like, you know, keep bad deals out, right? But if it's a good enough deal, okay, let's get this thing to approval. We need that fee. We need that yield spread. We want it in our portfolio so we can continue to grow because we got our growth metrics and our CEOs giving us what we got to grow each quarter and everything like that,
Correct.
right? So I've wondered about that, about like, okay, you got borrower that's got, $500,000 in, and I'm air quoting now, liquidity. But he's also
Yeah.
pointing to his IRA account from his prior job, or he's pointing to some like line of credit that he's got, or a credit card with a balance on it, with no balance on it, or something. So he'd stitched together a little bit of, liquidity, whether it's real or not. And they got
Yeah.
some balance sheet, net worth. But as you said, they're using that on 4 other loan applications that they have, or loans that they already have that
Mhm.
are mid-cycle. So when what
Correct.
hits the fan blades, all
Correct.
these banks are all showing up saying, "Hey, you told me you had $500,000 worth of liquidity." I'm like, "Yeah, well, I promised that to these other 10 banks too." So,
Yeah.
yeah,
And same thing with appraisals. Like the appraisal industry is very gray area as well. Like there
do
was
tell.
times where an appraiser would come back, we would get the appraisal on a deal, and maybe it is like a little bit lower than what the borrower wanted. Like, their as stabilized value a little bit lower than what they wanted. And the borrower is putting pressure on their loan officer, like, hey, you really need to get these proceeds up. You really need to increase this loan amount like we thought or underwriting. And so the loan officer would go back to the appraiser, like, hey, did you check these? Did you check this comp out? Or like, hey, I think we can get these
Mhm.
rents higher. Or did you think about this? And then
Were you the
magically,
one making that call? Were they asking
I
you to
was
call the
not.
underwriter, to call the appraiser up to say, "Hey, it looks like he appraised it for 10. I want to show you why
I
it's
was
worth
not.
11.5." No, that
So
were
I was the underwriter. I was like really like working like under the loan officer, and then they were like the more like the customer facing person.
oh, the LO
But
was
then
the
yeah, I
guy that
mean
was
just
they're calling the appraiser. Okay.
yeah. And then magically a couple of days later the value would come back with a revised appraisal and it'd be a lot
Mhm.
higher and it's kind of, so it just there's
Well, the
just some
loan
gray
officer's
area
the
like
one,
in
it's
that
follow
world.
the bouncing dollar, Justin. The loan officer's the one making the commission and everything like that, and God bless all you loan officers that are listening to this show and everything like that. And again, we're just syndicators are, where they can be. I'd like to think that there are many great operators out there, and I know there are. It's not that I try to think that. I know there are, but there are
Of course.
syndicators too that are just doing this thing for the acquisition fee, right? Just like an LO that's gonna try and push through things that's short-sighted and everything like that. So I think some of the short-sightedness, greed gland did kick in, which maybe pushed a few more bad loans into the cycle, or caused an
For sure.
operator to do maybe more deals than they should have because of the greed gland. But that's not you and me. That's not who we're talking about. And currently, best ever listener, we're not talking about you. Pigs get fed, hogs get slaughtered, as they say, right? So let's move on. So somehow or another, you looked at other people's balance sheets when you're underwriting these deals and saying, interesting, this person does not have a W-2 job. They're a business owner and they're able to claim all the net worth that they have for all their other projects and whatnot. So you saw the Kool-Aid sitting over here on the dark side of operations. Was it an aha moment after a couple of years on the banking side? Or was it did you have that light bulb go off early and just figured you needed to spend a couple of years getting your feet wet and then jump over? Like when was the moment that you decided enough? I can't do this anymore. I need to get on to the operation side.
Yeah, I mean, so yes to the second part of your question. Like there was like an aha moment, and I was already sort of like I saw the benefits of commercial real estate, knew I wanted to do that. But I guess like there is like a funny story. I mean, the short version is I was already working at the bank, but also looking for like my first commercial multifamily deal.
Okay.
I was already sort of like in that world, looking for deals, working with some mentors, had some friends that were like in the same game and trying to do this finding the first deal as well. But long story short, I was already looking for deals. I was sending out direct mail campaigns to different owners here in Indiana, and I think this is what happened, but one of those owners saw my postcard. I'm pretty sure they looked me up on LinkedIn
Yeah.
and saw that I worked at that bank. They then called like their point of contact at the bank or who they knew at the bank, and they're like, "Why is like one of your employees like sending me this postcard to
Oh,
buy my
no.
40 unit or whatever it
Yeah.
was?" And so I think it was like the very next day, I got called in the office, and 10 minutes later, I was fired just like
No
that.
way.
Yeah. So I was like sort of propelled into real estate, but it turned out to be like the best thing that ever happened to me. That same week, an owner of a 33 unit property on the west side of Indianapolis called me after getting that postcard, another postcard, and that was the first deal I've ever closed. Like he called me the same week I got fired from that W 2, and I've never been back to a job like that again. That's my first deal, and then
Yeah.
since moved on to other deals and et cetera. But that's what sort of like propelled me into
Yeah.
real estate full time.
I'll get a little like, hokey here. Do you believe in the concept that when one door closes, another one opens? Like, is that a fact, or is that just a fun thing people say?
100%. I mean, I really do think it's like the best thing that ever happened to me. I think
Yeah.
everything happens for a reason.
Yeah.
And while
People
like, I
say
already
these
knew like
things.
in my head,
Yeah.
yeah, like I already knew
Yeah.
in my head I wanted to
Yeah.
leave this job and pursue real estate one day. But
Yeah.
everybody procrastinates. Everybody gets comfortable in that W-2 position. Like, what if I'd been working there for the next 10 years and I was just like kept procrastinating year after year. It's like, oh, I'm not ready yet, or I'll do it when this timing's right. But this like really just propelled me into doing it now. Like it forced me into doing it now. So like, yeah, I do think like everything happens for a reason. It turned out to be
Yeah.
like one of the best things that ever happened.
I
So
love that story. I love that story. And you know what's funny, Justin? Had you not pushed the envelope a little bit to start sending out those postcards, you still, and I'm not saying this, whatever it is, you still could be at that job right now. Yeah. Years and
yeah,
years
of
and
course.
years later, right?
Yeah.
Had you not pushed the envelope and decided to get a little uncomfortable, and everything like that, to try on new things, to try new territories, because you just never know where the winding road of life is going to end up if you don't push a little bit, you know?
Yeah,
And so by
100%.
you pushing, I hear sending out those postcards, freaking knucklehead hater, started like, why is your guy? Did you ever come across that guy, the 40 unit guy that turned you in?
No, but I don't know who it
You don't
was
know
or
who it
what
was.
happened. I think that's what happened. They didn't
Yeah,
tell me, but I think I don't know how else they would know I worked at that bank
of
and
course.
how they found out about it. But yeah,
No, but like the seniors at the bank, the directors were like, are you pursuing? Did they sit you like, are you pursuing buying your own deals? Yes, I am. Okay, great, you're fired. Like
yeah.
that.
I mean, I think at
Yeah,
the end of the day, like I understand, like there was just conflict of interest,
yeah,
but I think it's just like a big misunderstanding at the end of the day. But
yeah.
either way, everything happens for a reason.
No, I get why, and I'm not saying that I would have done the same thing if that were your director or whatever. But I get it because they want you to be
Yeah,
loyal. That's the company machine, man.
correct.
You can't want to do your own thing. You can't want to leave the company. You can't want to do your
No,
own stuff. And I get, not for
no,
nothing. You're over here looking at other people's balance sheets and deals they're doing and everything like that. You probably shouldn't be working there anymore if you're trying to do your own deals, right? So
right.
it's probably a good exit point. So that's amazing though. You get let go and then a postcard strikes and the 33 unit shows up. Give me like some tactics on the postcard game that worked for you, because a lot of best over listeners, like honestly, a biggest struggle that people have, two struggles I see in the industry right now, Justin. Money, deals. Sounds stupid to say, but it's a fact.
Right.
People getting money, equity, right? Equities become way markedly higher to come, harder to come across, and we'll get into that in a minute. But deals are certainly harder to come across now too. Sometimes I feel like the brokers didn't get the memo about what's going on in the industry and whatnot. That we're in the middle of a commercial real estate correction right now,
Correct.
and nobody told any of the commercial real estate brokers because they're still out there trying to sell stuff at a 5 cap and assuming everything to be really competitive and whatnot. So you went against the grain on that and did mailers. Had you learned how to do that? How did it work? And give me some tips for the best ever listeners that are struggling finding deals right now.
Yeah, I mean, great question. I think if it's your first multifamily deal, especially your first, but even if you're just looking for really good off market and undervalued deals,
Mm-hmm.
I think going direct to seller is a huge advantage. And not a lot of people are doing this today. I mean, you hear about it, but not everybody out there is actively doing this. They're just kind of taking the, least resistance path and going out there and talking to brokers. But we all know that brokers are working for the seller at the end of the day. They're trying to make the most commission. And so they're trying to sell it at the highest price they can. So yeah, I think postcards, cold calling, and even cold email. I found and closed a couple deals from a cold email. I think all those methods are awesome at finding like real value add deals, like off market mom and pop owners. So you can skip the broker and go straight to the seller. But yeah, I think all those three methods are
You know,
gold,
the
and
why makes
especially when you're
sense.
looking for
The
your
why
first
makes
deal.
sense, and I see a lot of my friends that are on they're more transactional guys that are doing, like, the single family wholesale game, right? I've got friends that are doing that, that are, like, wholesaling tons of product. God bless them, that's a freaking grind. I just don't have I don't have the heart for that one, man, but people do,
Mhm.
and they do very well. God bless them. I'm talking about doing what the game you're playing that you were playing at back then on the commercial real estate side, because you're right, that tactic happens all the time on single family, but
Yes.
to go after commercial owners is an interesting angle. Were you targeting distress, or were you just targeting anyone that owned a commercial deal? Give me like the parameters that you filled your data set with
Yeah.
when you send out those postcards.
So I was targeting owners that haven't sold over 10 years,
Mhm.
or not within the last 10 years, and then properties between 5 and 30 units, and then just in the market that I was looking in as well. So not like your quote unquote distressed deals, but
Yeah.
just properties that were built between, 1970, 1990, and just haven't been sold in the last, 10, 15 years. I think that's a big one as well.
Yeah, so they've held it for a while. They built up some equity, likely paid the mortgage down for a while. Did you target anybody that was holding the property in their own personal name? Like that's a mom and pop move right there, is to hold it in their own personal name and that kind of thing. And some of
Those are
them
the best.
have lawyers that are smart enough to tell them to use LLCs. So I'm not saying that like it has to be personal name held, but you probably encountered that too. Uh, and is it okay to target to, like, can we say, you were buying in Indiana? It seems like you're building in Indiana now. Was that your buy box for, the multi that you were doing back then too? Indiana?
Correct. Yeah, very focused here in Indiana.
Okay. Is it just 'cause you like to operate in your own backyard, or just because are there other factors that made that your buy part of your buy box?
Yes. I mean, I do like operating in my own backyard. I do like being within a, couple hours distance of any property I own, just with me being a, small growing company, small team. It's just a lot easier for me to drive a couple hours or
Yeah.
even less if I need to versus taking a plane a couple states over. It's just a hassle for me right now. Two, like
Mhm.
I'm here in Indiana, and which I just think already is a very just, fantastic Midwest state, very strong, stable market. And
Mm.
so I really have a lot of motivation to look elsewhere right now because I already think Indianapolis and other cities here are just fantastic for real estate investing.
Okay. I know, but Indianapolis is the big employment hub, right?
Correct.
Okay,
Yes.
okay, alright. Yeah, I think it's important to have, like, a job center, right? And that, so for the
Yeah.
rest of the listeners listening, they're, like, literally legit out in the middle of nowhere, not near a major employment center. That might not be the best place to invest in multifamily assets. You gotta have a place that like, a thriving place for people to go to work, but it might not need to be Austin, Texas, like the absolute core of where growth is happening job-wise. It could be in other places, as long as it's a larger metro in that. So I like that. So give me the journey. Thanks for unpacking a bit about. I've always been curious about people that are doing a lot of target direct to owner stuff in the commercial real estate world. So thanks for unpacking that a little bit. Give me what that journey looked like the next couple of years. So you're out, you bought a 33 unit. Give me what the ladder looked like from there.
Yeah. So since then, I've partnered on like around like 400, 450 doors on the value add side, some small ones, large ones, some as lead sponsor, a few as just being like a more of like a helping out with the equity and asset management role of it. Since then, I've kind of made a pivot in my business and fully transitioned into ground up Class A multifamily development.
Oh yeah.
Still here in Indiana at the moment, and happy to chat about why I made that transition. But yeah, for the past 3 years or so, I've been just strictly focused on Class A development. I think that's like another important factor as well. Like whenever I'm doing something, I like to stay like very like laser focused on one thing. So like one strategy, one
Yeah.
state. versus trying to do like all these different asset classes and different markets. Like, I mean, me personally, I just like staying laser focused on one thing.
The most successful entrepreneurs that I know are laser focused, and that I think that's
Yeah.
some of the key. That's one of the keys to success of entrepreneurship. I think is just leaning into a thing, and that's it. So let's get into what you learned a little bit about the value add multi world, and also really curious about your transition into development. But before we get there, we're going to take a quick word from our sponsors, and we'll be right back. Best of our listeners, do not go away. Don't touch that dial, as they say. We'll be right back. All right. All right, best ever listener, we are back now here with Justin Goodin with Goodin Development. Justin, we were talking a bit about your transition to the value add multi-space, 450 units, focused right there in your home state of Indiana. Give me what was that? Was there a specific vintage you were targeting, or were you somewhat kind of open to whatever, or was it like all C-class workforce housing, lower like 1970 stuff, or was it newer build? What was the vintage and typical asset you took in?
Yeah, so at the time, it was like your typical, 1970s, 1980s, older
Mm-hmm.
product,
Yeah.
C plus kind of deal. So like all your like underperforming and, under market rents and outdated units, like just your typical kind of value add deals that I was targeting back then.
Oh yeah, yeah, yeah. What was that? Did you manage yourself or did you hire a third party?
All third party management, third party construction. Yeah.
You never wanted to get in. You've never gotten to vertical integration. Why?
No, even now in development, I get that question a lot. I mean, not saying like my thoughts or my goals won't change in 5 years, but going back to like being like laser focused, I think I've heard both ways. I've heard amazing pros and benefits from having vertical integration, and I've heard developers and other syndicators say the complete opposite.
Hmm.
But I mean, for me right now, and just being a smaller company, a smaller team, once you start a property management company, or once you start a construction company, I mean, you're no longer just in your core business. Like now you're a property management company owner. Like now you own a construction company. Now you have overhead,
Hmm.
payroll. So I think not saying like all companies are like this, but I think when you have that sort of pressure and all that overhead,
Hmm.
you have to keep feeding that machine every month. You have to keep doing deals, and you might not come across deals. Like maybe you have to get like more skinny on your assumptions and be more aggressive in order to keep fitting that machine. So not saying that happens to everybody, but there's a lot more just overhead and pressure. Um, Again, like not saying like I won't change my goals in 5 years or so, but
Yeah.
right now, like I just like being a developer. I like just building projects and just moving on to the next one and not having that headache and stress of having a construction company and the manager company and then having those different verticals to worry about.
Yeah, yeah. No, I mean, there's something to be said for that because it is really like kind of leans into that book, the one thing, right? Like your one thing is what was finding opportunities, bringing them to their highest and best performance levels, and then kind of taking it from there without you having to worry about. Really, you're right, a property management company, and take it from somebody who does own a property management company, me. It isn't a whole nother business. It's a whole nother thing,
Yes,
and
so
it's
I've
like, do
heard.
you need another thing? Do you need a lot of things, or is it better to just have the one thing, right? So I totally feel you, and sometimes I do question why we ever did it, right? Because it is a whole nother animal, and when you get to scale, there's enough of that machine to feed it and to pay the payroll and everything like that, and to have staff that can run it and everything like that. But it is certainly another thing that you have to think about.
Makes sense.
Yeah. What are some of the biggest lessons and takeaways that you brought away from that value add side of your business, from building up to those couple, the hundreds of units that you had?
Uh, yeah, a couple things. I would say like go back to being under promising and over delivering.
Hmm.
Not stretching your assumptions just because you want to get into a deal or do a deal. I would say like don't always focus on unit count. I think a lot of syndicators in the past, 5 years have focused on unit count because it looks flashy and cool on social
How
media.
many doors you got? I got this many doors. How many doors you got? It's like how
Yeah.
big is yours? Mine's this big. How big is Yeah, yeah. Get out of here.
Yeah. I'm
Yeah.
not saying like you can't scale and nothing wrong with scaling and doing bigger deals, but there's nothing wrong with doing a 40 unit or a 60 unit. I mean, just getting your feet wet and starting like that.
Mm-hmm.
I think when you go like above 100 units and 150, like that's like it's just a whole different game. You're buying from other investors and selling to other syndicators on the back end. Where if you go to like smaller properties, then you can find like better deals potentially, buy from like mom and pop owners. So buy off market, sell on market. Another thing is, like going back to like focusing on not always focusing on your unit count and scale, but focus on how much equity that you own in these deals. I mean,
Mhm.
there's no sense in owning 5,000 units if you own a couple percent in each of those deals and you're still working a W 2 job. So
Mhm.
there's people out there that are making more money from their 50 unit they own with a couple partners than the 200 unit they own and they have 2% in it. So
Yeah.
always focus on your equity and how much you're owning these deals versus just trying to get into the biggest possible deal just to make it,
Yeah, I could
sound
see
cool.
that. I could see like, a couple of guys that are good income earners. I'm sorry, guys and people, a couple of people. And I hate it when people say just guys. Right? Okay, you're right, you're right. I could see a group of people getting together and buying like a 30 unit, right?
Yeah,
And
100%.
that's it. And that's just part of their retirement plan or something like that. And having a good PM company that's willing to run it. And you put, 5 hours a month and you go drive by there once a month and you're a good owner you're a good custodian of the asset. And you let the debt amortize over time and whatnot. You don't have to buy a couple thousand units. That is part of some people's
Mhm.
business plan. That is part of some people's
Sure.
goal set, but that does not have to be that for everyone. So I like I think that you are spot on that a smaller asset like that probably has a deeper buyer pool, but like a
Mhm.
30, 40, 50 unit, where, and some syndicators aren't going to touch it. I get that.
Right.
But there's probably a wider group of people that are not full-time professional investors that might be willing to pay you a little bit more for that asset just so they can have something in their portfolio. I like it. Is the
Yeah.
majority of the 450 that you guys took down, were those sub 100 units like we just talked about, kind of like 30, 40, 50, 80 units here and there?
Majority.
Okay.
Yes, majority.
Okay.
There's a couple that are over 100, but yeah, majority.
Okay. Do you still hold them?
I do.
Okay,
I still
good.
have even the very first multifamily deal. It's in our portfolio even today.
Yeah.
It's actually on the market right now. So hopefully that'll be the first exit coming up soon. But as
Oh,
you know, it's kind
good.
of like a frothy time in the market
Yeah.
right now. So we're gonna see what happens.
So give us, I want to take one thing away before we get into why you transitioned into the bigger development stuff. When you're acquiring, I find that a lot of the time that I see for myself, for my business, or for those that I talk to, for those that are in our industry together, a lot of the time is spent either raising money or finding deals. Once you've got a deal, then a lot of your time is spent stabilizing that deal.
Mhm.
Then, like I have a 49 unit, right, in Lancaster, Pennsylvania. I want to tell you, Justin, maybe 2 hours a month, on that 49 unit, and it
Wow.
pays me well. That's because I worked my ass off in the beginning to fund it and to get it renovated and to get it stabilized and everything like that. Now it kind of runs because I've done the work, right?
Correct.
How
Yeah.
much time are you putting into the 450? Because I know you're not looking to acquire more value add stuff like that. And you're not raising equity for that anymore. Now that you've got a stabilized
Mhm.
450, uh, how much time do you have to put into that versus the other side, the growth sector of your business, the development side?
It's pretty much exactly what you mentioned for your property, but
Yeah.
very, very minimal. Because yeah, like you mentioned, like we've already done the business plan, we've already renovated units,
Mhm.
we have fixed rate debt on all these deals. There's really like no big
Yep.
headaches.
Mhm.
So very minimal, like a once a month call with a PM company,
Yeah.
maybe a couple hours a month on these things, but yeah, very minimal
Yeah.
to your point.
Boots on the ground, and you're lucky enough to have all this in your backyard, proverbially,
Correct.
right? Not literally, but within a couple hours, right? So you're able to get boots on the ground, get eyes on when you need to, and everything like that. So that's interesting, and I think that pausing the growth cycle on a effort in a business, if we can stabilize an angle that enables you didn't have to sell everything. I was curious about this when we began this interview. Did Justin have to sell all his stuff so that he can go do the new thing? And he didn't. He stabilized it so that he can go and do the new thing. What was the aha moment that you had that we talked about the aha moment where you were banking, that day when you sent the wrong postcard to the wrong guy.
Yeah.
So what was the aha moment like here for the value add reno cycle that pushed you over into new construction?
Oh yeah. Happy to chat about
You
this.
tell.
So, I mean, as you know, in the last, 5 years or so, or whatever it's been,
Mhm.
but there's
It's
just
changed a
so
little
many
bit.
eyes
Yeah.
and that there's just
Yeah.
so many eyes on the typical, value add multifamily deal. And I just saw like the entire space just became very, very inflated
Mhm.
with just all the different coaching groups. Nothing wrong with that, but all these different groups and podcasters and influencers all talking about value add multifamily.
Well, it's easy. All I gotta do is, buy a couple rental
Oh yeah,
properties,
it's
and I can
totally
just
easy.
surf all day, or go buy and I can buy Ferraris and surf all day. That's it, right? That's all you gotta do. And put in 1 hour a
So
year. That's it, and I get to live my best
yeah,
life, right? Yeah. Okay. Anyway.
so this
Yeah.
caused just like I think like it just caused like a massive influx
Uh
of
huh.
all these different groups and buyers going after the same kind of property.
Hmm.
And so like it was like back in 2023 after I've already done some deals and of course I'm looking for more deals and trying to scale. I went like an entire year without finding a deal that, like penciled out in my model. So I went like an entire year without doing anything. And I just saw that there
You
was
did a lot, though. I bet you did a lot, but you didn't
well,
do.
yeah, I did a lot
But
of
it wasn't
working, but didn't
productive.
like really have like any ROI. Yeah.
Yeah,
So
it wasn't productive work, but you probably looked at a lot and said, "Nope, that's not gonna work," or yeah, yeah, yeah.
oh yeah.
Oh,
So
goodness.
nothing worked out. And I just think there was just so much competition looking at your, just standard 1970s, 1980s value add deal.
Mhm.
And just so many groups looking at this exact same thing. So, anyways, answer your question. I had another friend of mine here in my local city, and he had a new development deal here in Fishers, Indiana, which is just about 10 minutes northeast of Indianapolis. But he had this deal. He had the land already tied up. He had it under contract and was already working with the city to get everything approved. And he needed help signing on the loan and raising equity. And so I didn't know much about development at the time, but it was an amazing. If anybody, any of your listeners like know Fishers, Indiana, it's an amazing area, an amazing suburb here in Indianapolis, a very high growth area.
Yeah.
And so the market attracted me for sure, and just like the benefits of owning a newly constructed product and new everything, new roof, new appliances, all those things made a lot of sense to me. And he already been doing this for 15 years previously. And so I had the opportunity to partner with a more experienced operator on the new development side, saw the new construction process, and that one actually just got finished with construction last year in 2025, and now we're leased up and stabilized here in 2026. But I saw so many benefits to new development. I mean, one being I think there's less competition
Sure.
with the higher barrier to entry. Two, we're seeing a lot of other syndicators and groups pivot from like the older 1970s product into wanting to buy newer construction and newer product as well. So I think there's a lot more demand from buyers into newer product.
Yeah.
And then three, I think there's just, less crime, there's less repair and maintenance headaches, there's a better tenant profile in these new development properties.
Mhm.
All these things I saw like just had like more benefits to the development side versus value add, which is
Yeah.
why I ended up making the switch and just becoming laser focused on Class A mixed use development here now.
Absolutely, absolutely. When you said that the barrier to entry is different for new development, right? Can you go? I think I know what you mean, but I want
Yeah,
to go there and maybe challenge you a little bit. So go and unpack that a little bit about the barrier to entry for new development compared to buying a '80s vintage, 50 unit or something like that.
yeah, of course. So on the development side, it might be I haven't ran into this yet, but it might be years before you even start construction on a deal.
Hmm.
So we have a deal underway right now in Kokomo, Indiana. It's 114 units. And I spent 13 months with that deal before I even broke ground on construction.
Sure.
So there is an incredible amount of upfront work and time and knowledge, expertise before you even get off the ground,
Yeah.
which, I just think not a lot of people are willing to, one, take that risk and then just learn how to do those things. I mean, of course, there is competition in development. I mean, of course, there's institutional companies doing the 200 unit and 300 unit type projects. But in the space that I'm currently focused on now, between 50 to 150 units, call it. I mean, there's not a lot of companies doing projects like that here in Indiana. So I'm actually
Yeah.
coming across more deal volume and more opportunity since pivoting into development.
Okay. So there is a time barrier to entry in that, like, I
Correct.
can't buy a hunk of land and build an apartment building and be collecting rents, within a couple weeks, right? As I could be on a
Correct.
on a new build, right? Is there, because I think this is a conception. This is what I wanted to unpack this a little bit. is there a financial barrier to entry, right? Like, does it cost more? I know that it costs more per door to build because I get cost of construction, replacement cost, those kinds of things. I'm
Mhm.
talking about more equity you got to bring to the table, right? If you look at dollars in equity per door that you need to bring on a new build 50 unit versus a 80s vintage 50 unit, is that a fallacy? Because I think that the best ever listeners might think that there is more cash per door required when it's all said and done, once the paint's dry, uh, for building that 50 unit versus buying it. Is that true?
Are you asking, like, do you get, like, more
Equity.
yield out of the property?
Yeah, do you get no, not yield on the backside, not profit, right? Because I know I'm certain you do because you higher rents, all the things, right? I'm asking
Okay.
dollars per door going in on equity. I guess that's what I'm asking. Like if I'm putting together an equity stack, right, to
Okay. Okay.
build a new apartment building, right? Do I have to assemble more cash than I would if I were to buy a 50 unit? Because I think some people think that the 50 unit existing 80s vintage is pound for pound a lot less equity that I have to assemble. I've heard that that's actually not true. But on the build side, your money goes further, but it takes a lot of time. Is that true?
In my experience, yes, you are raising more equity, for the development side. You
You
can
are.
get, like, the higher leverage,
Mm,
correct, on the existing side. My last 3 projects have been between 52 and 55% loan to cost. So that's a
okay.
considerable amount of equity you're bringing to the table, for
Okay.
these projects.
So you do need a lot of equity going in. Okay. I just based
Correct.
on lending requirements and everything like that. But it's a shorter time cycle than like if I'm buying a 80s vintage, I'm going to hold it for at least 5 years, something like that. Right. But on a new build, I certainly have more exits. If I'm building something, I can refinance it, hopefully get some of my equity back out, or I could sell it.
Sure.
Yeah. Okay. Um,
Exactly, yeah, you have different options at the end too, refinance or, hold on to it, yeah.
yeah. How did you do on that deal north of Indianapolis? The first one
Yeah,
that your buddy brought to you, like that was your light bulb moment, right? How did that give us like what the bumps in the road look like and the wins and how that deal went and why that caused you to pivot into the development world?
so, I mean, yeah, I guess, like, the first development deal, the construction side went extremely well. We were, under budget, under
Awesome.
timeline, went extremely well. We started achieving rents above our original projected numbers when we started leasing. I guess, like, the biggest, like, bump in the road, and I'm hearing this from a lot of different operators right now, is that, concessions are up, vacancy is slightly down. And so this one was an 84 unit property and it had 20,000 square feet of commercial space to it as well. The commercial space was majority pre leased before we even opened it up. It's 100% leased right now. And this is an 84 residential unit property. And it's been about a year and 1 month now. And we just touched 90% this month as we're speaking. And it's been a very, very slow lease up progress on that project simply because of the market. It's a very, I wouldn't say it's oversupplied, but there's a lot of competition in the market. So a lot of different properties are offering concessions and, 2 months free. You have residents moving out to buy some houses. You have people concession hopping. So moving out of one property and then taking advantage of the concession and then doing that over and over again every year. So it's been a slow and, uh, steady time getting that thing leased up.
Hmm. Okay. Okay. So
Yeah.
have you seen, because I've heard of this too, that for a new build going folks that broke ground on things a few years ago before rates were before rates went up too much here, that they expected things to underwrite a certain way. And then as rates changed and as the banking world changed and that kind of thing, there's been more challenges to refi in that. Have you guys had those challenges? Are you not going about it that way? What's been the changes? Well, once you achieve that 90% occupancy point, once you get there, then what? Right? Are you looking to just cash flow it, refinance it, that kind of thing? Or are you looking to get it off to another owner? Like so now what? Then now that you're 90.
Yeah. So I will say that the, first goal of any project that I'm doing is to build, stabilize it, and then sell it as
Mm.
soon as possible.
Mm.
With how the market is right now and what we're hearing from like other just, the bigger name brokers here in Indiana, it's not the best time to sell unless you absolutely have to sell right now. So we have gotten some BOVs. It's not like really like the price we think it could be in a few years. So, now that we're, somewhat stabilized, we are going to actually look to refinance this one, return some equity to investors, and then can, just continue holding it and cash flowing it. But our main goal is to, just build these properties and sell them.
Yeah, yeah. And I suppose when you refinance it, you can take it over to one of those government agency programs that has assumable debt on it, right?
You can, yeah. We're looking at HUD right now,
Mm.
possibly doing like another, like doing a bridge to bridge, and then having like more flexibility to be able to sell in a couple of years if we wanted
Hmm.
to. So
Okay.
we're looking at some different options right now. We're in a fixed rate construction loan right now. We could get into another bridge
Yeah.
that's floating with a rate cap and still be protected in all those ways as
How
well.
difficult is HUD? People always tell me like it's like brain damage, right? Like you like
It would take
feel,
about 9, 10 months right now
does it
to
really?
close. So
Nine,
yeah,
10 months to close HUD. Yeah.
yeah.
I
There's a lot of
mean,
red tape that I've heard as well too.
I've heard that too, but I've also heard that on a new build that I mean HUD likes people told me that they're in essence your business partner because they get up in the middle of it and everything like that and they're going to want repair reserves and escrows and that kind of thing. But for a new build, your repair reserves are going to be just about zip because you just built it, man. What replacement reserve do you need, and
Yeah, it makes
everything like
sense.
that. So is that, I don't know how far down the road you've gotten with them, but I've heard about the red tape. I've heard about the things. I've also heard really, really good stuff. Like they'll lock your rate for 30 years and you can reduce your
Right.
rate over time if rates in the world come down, which, we're all hoping that they do.
Yeah.
Yeah. That's one of those things where there seems to be more flexibility if you're willing to deal with some of the pain in the butt that they bring. Is that what you found?
Yeah, that's what we're hearing. We haven't made like any decision yet, but it's just an
Yeah.
option we're exploring, and yeah, we'll see what happens.
I got people that I know in this industry that swear by it, that love HUD, and I got people
Yeah,
that have tried it and have the battles. They're like, yeah, I got the battle scars to, and everything like that. And I'll never do it again.
yeah. Well,
Mm.
when I was working at the bank back in that time, that's like their main specialty was taking bridge to HUD,
Mhm.
and so we had borrowers locking in, if you can believe this. I mean, but locking in 35-year loans at like 2 something% interest rate, which is basically like free money. So that's those loans are still doing really good today.
Oh
I'm
yeah.
sure,
Well,
and they're
that was
happy
the
about
time to
that.
do it. Back in
Oh yeah, that's perfect time to
2019,
do it.
2020, you look like you're brilliant, man. Look at me, huh? Right. Yeah. A good time to lock. Yeah. God bless.
Yes.
Okay, so fully transitioned out of the value add stuff. We're just kind of letting that churn over on the other side. New development thing going well. It sounds like you're really flourishing in that space. Tell me, like, what are you curious about next for good and development for your company? Like, as you continue to grow and expand, it seems to me, from what I look at the arc of your personal trajectory and on your business and everything like that, I see you climbing into levels of sophistication, complexity, everything like that through your business. That's what I see. I see an evolving, somewhat a company that's taking on, very measured, very smart levels of sophistication when it makes sense to do so, right? What's the next rung on the ladder? What do you see next?
Yeah, great question. I mean, for me, like I want to continue growing slowly but surely.
Yeah,
I'm not looking to. I don't have like any unit count goals. Like I need to do 5,000 units by
good.
the next 5 years. Like I want to do very calculated, very realistic projects. Because of course, it's development. There's a lot of benefits, but also a lot of risk. Of
Yeah,
course, I'm just looking to keep growing, slowly but surely, and just keep taking very just calculated risk for me and my investors as well.
yeah. Do you love
But
the
next
development world
steps,
enough? Do you love the development, like the build up world enough? Seems like you're in a good market that's not, growing like unsustainably, like other markets in the US are. You're in a market that I have heard is growing smartly, at, a couple percent a year, going to keep doing that for this foreseeable future. Do you
for sure.
see yourself just doing more of the development thing and just kind of putting one foot in front of the other in that space? Is that where you're thinking of leading your company, of just smart growth, kind of continue to do that one thing over and over and over again?
Yeah, so I want to keep, building here in Indiana. I think eventually we'll start looking out of state as well, and maybe moving into some neighboring states near Indiana as well. I also want to start working with institutional equity. So again, I can start, just keep being a developer, keep focusing on deal flow and projects, and then already have like an equity partner lined up, like a family office or JV equity group. So I'm still kind of building some relationships around that side as well. And then I want to keep building like my repeatable product. So if you look at our past 3 projects, they're all unique in their own way, but they're all very, very similar. as far as architectural standards, look, quality, floor plans. So I'm not like looking to like reinvent the wheel every
Yeah.
like new project I do. We're taking like what we like and we found like what works and taking that to, like every project we do. So if you look at a lot
Mm.
of successful developers, their projects are like that, where they're they're all unique, but they're all very very similar as far as like how they
Oh,
look
man, no,
and
they're not
the
unique.
styles and
The developers that I see that are really, really good at this, man, if you've seen one of their buildings, you've seen all of them, right?
I was trying to be nice,
They
but yeah,
figure out an
they can't
equation
look the
that
same.
works. I'm not saying that there's not an art to our business. I get that. But if you figure out an equation that works for construct dollars per square foot to build it, and the residents love that tile color and they love that paint color, and these things are getting
Right.
absorbed quickly in the market, and people want to make this their home for the way that I'm making it look, why change it, man? You know, like
Right.
why like change it to the point where stumbling into something that doesn't work, right?
Yeah, there's already so many variables and
Yeah.
unknowns in these deals. Why add another variable? So yeah, I agree.
Yeah, if you get it right, you know, I mean, no, your buildings probably should all look the same if it's working, you know, what the heck, you know? Awesome. Well, Justin, this has been a great conversation. I'm really enjoying it here. I love to have more chats with you. Maybe enjoy Best Ever Con with you coming up in March and that. So let's look out for that for you joining us there. Uh, and for those that want to reach out to you to hear more about you and about Gooden Development and about Indiana and new builds and all the awesome stuff you are working on, how do people get a hold of you?
Yeah, I'm pretty active on social media. Happy to connect with anybody. You can find me on Facebook, LinkedIn, Instagram, and YouTube, all just Justin Goodin. And then you can also find me at my website, just goodendevelopment.com. It's GOOD as in dog, IN, development.com.
GoodinDevelopment.com. Check out this rising star, Best Ever listeners. Justin, thank you so much for being with me here on the Best Ever CRE show. Appreciate your time. And Best Ever listeners, hope you guys enjoyed this program. If you guys liked this program, make sure you like this program on the podcast app that you are using, and make sure you write me and Justin a great review. Make sure you share this program with someone that is in your circle that's a rising star too, that's in the value add game, that's maybe expressed a little bit of curiosity. Man, new build, that seems like too much of a barrier to entry. It seems too hard. Justin's made it very accessible today. So make sure you share this program with those that are in your circles as well, so we can continue to grow the message coming out of Best Ever CRE here. Thank you, Best Ever listeners, for joining us today, and have yourself a best ever day.